Welcome to Early Edge Club, where we break down one microcap or SME stock a day using our simple structured 20 factor scorecard. Microcap investing can be rewarding, but it's also full of traps. Our goal with this series is to help every retail investor avoid the common mistakes and develop a more thoughtful approach when it comes to investing. If you're new here, I recommend checking out the explainer video on how to use the scorecard. Try scoring the company yourself as it will give you real hands-on clarity. Today's section is divided into understanding first the business model, the industry, and then we use our 20 factor scoring, and finally our take on valuations and risk. This company analysis and discussion are part of our internal conversation as we review companies from our ongoing 500 plus microcaps and small cap stocks. We are sharing this to retail investors can build a structured framework when it comes to microcap investing. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
So today's company is Paramount Wires and Cables. Let's go on to the business overview. So Paramount is basically a company which is involved in manufacturing of cables and wires, and they are manufacturing a lot of products catering to every segment of the cables industry. They were one of the largest cable manufacturers in India, and then their story is very good. I'll move on to the story. It is a very big turnaround story. So they were profitable in till 2007 and 2008, and in 2008 they were doing more than 400 crores in revenues annually. But what happened is the 2008 crisis, global financial crisis came, due to which they had a very rough time. And during the same period, they had acquired a company in UK. So AEI Cables, and cables company was doing similar revenue, 400 crores of revenue. So similar to Paramount was doing in that time. So what happened? They acquired that company, and then this financial crisis happened, and demand for their products went down a lot. So both Paramount Communications, their own company, and AEI Cables started making losses. And from 2010 to 2017 or 18, they had a very bad time. They had to eventually give up their acquisition of AEI cables because of the losses, and then they had to do all the restructuring of debt. And from 2010 to recent years, the promoters kept the company alive by infusing their own money around, I think it was 128 crores, out of which 45 crores were infused in the last 2 years, meaning FY23 and FY24. So the promoters had infused all which they had in the company to keep it alive. And then after from 2022 to 2025, the company has raised around close to 300 to 400 crores from equity, and mostly from equity, and they have cleared all their debts and completely turn around the company. So it was a very inspiring story because the promoters have been resilient. If you can see the product overview, these are some of the cables that they manufacture. They cater to different industry from telecom, railways, and other consumers also. Then moving forward to revenue breakup, if we see in FY25, majority of their revenue is contributed by power cables, and then 30% comes from exports, and exports also has similar bifurcation. Railway cables form the next big chunk, and after that, house wires are there. So this is the revenue breakup. If you see the management overview, so the management team is very experienced. Mr. Sanjay Agarwal has been with the company since a very long time, since the inception. He has taken the company from 1 crores of revenue back in 2001. The company is around 1500 crores of revenue annually. So he has been with the company and has guided the company throughout the whole time. And second, Mr. Sandeep Agarwal, who is his brother, he is also managing director. He joined just a few years after Mr. Sanjay. And next to him, SK Agarwal, CFO, he is also part of family. He has also been there in the company for a very long time. The core promoters have been with the company since the very beginning, and they have face all the turbulent times with the company, they have infused their own capitals to keep the company alive. Moving forward to industry overview. So as you can see, the cables and wires industry, it is a very big industry and it is growing at a very good pace. So projected, if we see the Indian wires and cables market value in FY22 was 65,000 crores, and by FY27 it is projected to reach 1,20,000 crores. So basically doubling of the Indian wires and cable segment, out of which it is expected by FY27, 80% of this would be branded. So we are, of course, in the branded segment, so the growth will help us. And which are the factors which are driving this industry? So infrastructure development, India is amidst one of the biggest infrastructure development in the world. So that infrastructure development needs wires and cables to do it because there are power generation companies. So power generation segment is also growing at a very fast rate. Railways, if we see though, so highest ever union budget was kept for railways last year. And there are other industries and segments which are driving the growth of wires and cable segment, especially data centers and everything else. Infrastructure is a very big part. Moving forward to, as you can see, so the rising power consumption, accelerated growth of renewable energies, growth in railway, metro, and highway networks, and these are some of the growth drivers for that industry. Historical performance, if you see in FY14, it was also doing 400 crores of sale. Then it dipped a bit, and then they had started recovering after 2020. So they had made a huge investment by raising funds and all, and they had restructured the company entirely. They made the company debt free, paid off all the debts, made the company very debt free. They are currently at zero debt. So for this, I think the bad times of the company has been in the past, and now the company is growing at a very good pace with good margins and good profits. So some of the key takeaways are, so, as per the management is aiming to deliver a 30% top line growth, 30% CAGR in top line, and reach more than 5,000 crores in revenue by FY30. It is driven mainly by the capacity expansion, the capex they are doing, and US and their focus on US exports. So in the exports market, they are basically US forms 95% of their exports. So they are focusing only on US because in US they have a good distributor network. Next, a greenfield facility which was awarded to them by the MPIDC. It is 31 acres of land in Madhya Pradesh. So they are using this facility to set up another plant. The total capex is estimated to be around 250 crores, and in phase one, 150 crores they are infusing. They are expecting it to be operational by the end of FY26. And from their existing two plants, which are at Dharuhera and Kurushera, they can do 2,000 crores of revenue. And when this new greenfield facility will be set up, it can do up to 1,000 to 2,000 crores of revenue in the first phase. And after which they are planning to do more capex there to fulfill that 5,000 crore target which they are targeting. In FY25, their current order book stands at around 650 crores, which is split basically equally split between exports and domestic demand. What the company is doing, that they are focusing on clients which are paying them faster, but even if it means that the company has to lower their margins in that contract. So this is something which I found a bit odd that they are doing. If we see the capex, they are doing heavy capex. This year it was 64 crores, last year it was 61 crores. As I said, the company has raised huge funds from the market, from investors, basically preferential warrants, equity, and QIPs also they have raised. They have in August they have approved a QIP of around 400 crores. Will be in tranches if I'm not wrong, and they have used majority of their funds in the last 3 years to meet their working capital needs, completely get rid of their debt and capex, of course. Moving forward to bull case. So the company has a very strong growth vision. So 30% CAGR, 5,000 crores plus revenue target. And then moving forward to next point, export strength. So they have a good penetration in the US market. They have a robust distribution network which helps them get faster payments, aiding their working capital cycles. Next, operational leverage. The new plant that they are setting up it is expected to have a high asset turn of 6x, and this can boost returns. Moving forward to bear case, so margins, there is a problem in margins because what the management is saying that he wants to do growth in absolute terms, not percentage terms. So what he had mentioned was that he will bring growth in terms of rupees, even if it means doing larger volumes at lower margins or higher low volume at higher margins. So it depends on the market condition. So that is what they are saying. And this is the problem. We need to have a good margin outlook for investors to be confident in the company because you can't go very low on the margins. Next point we have that they have a very heavy export dependency on US. Now currently the geopolitical risk that the world is facing and through that is coming from US, it is very big. Currently only they are paying 14 to 15% duties. So it is a very big problem because a lot of their revenue they are targeting for 40% to reduce their revenue to 40% from exports. Next, we come to our framework. So, section one governance and promoter behavior. So for this IPO and fundraise history, so there were multiple rounds raised. So I have not mentioned the exact figure, but 300 crores were mentioned in the con call. There were some other funds which were raised previously. So around 300 to 400 crores they have raised, out of which most of the funds were used for working capital needs. Some of were used for capex, and rest were used for repayment of their debt. So for that reason, I gave zero. A director and promoter track record. So director and promoter track record is excellent. They have been doing good work. They are experienced. So due to that reason, and there were no bad remarks found about them. So I gave 5 and 5 score. Related party transaction. So Valence Technology, which is our subsidiary, it is into a piping business. We have given a loan of 17.6 crores to it, and I think it was at a lower. I think it was at a lower interest rate than the market rates. So I gave 3 on 5 score because of the amount. Although compared to as a percentage of revenue, it is less, around 1%, but still I gave 3 on 5. Board independence and composition. So it is a professionally managed business. 7 directors are there, out of which 5 are independent. Just 2 are family on board. So I gave 5 and 5 score. CEO revenue compensation, if we see, so their salary is a bit high. But if you see 18 crores for FY24 for CEO and MD also, it is around 19 crores. So it is on the higher end. But considering their experience and their background with the company, I think it is justified. But still, I gave a 315 score. Moving forward, key person resignations, only 2 people had resigned. Company Secretary Ms. Rashi Goel had resigned, citing personal reason, and non-executive independent director had resigned due to his ailing health. So I found it as no problem. It was there. So technically, one resignation is only there because the other one was due to health reasons. So I gave 5 and 5 score and auditor resignation and change. So there were no auditor resignation or change. So I gave 5 and 5 score. Auditor opinion has been good, unmodified. Credit opinion has been, I would say, upgraded, but the ratings are different from different agencies. ICRA, it was triple B minus, and CRISIL they have upgraded to triple B, and for short term, CRISIL A3 plus. So I gave 5 and 5 score there also. Regulatory and legal issues, so they have been involved in some legal cases previously. And recently in Jan 25 PR, the Commissioner of IT filed a case against the company, 40 crores of IT demands in the appeal as per their annual report. So I gave 315 score. Moving forward to investor communication and disclosure. So yes, PPTs were there, con calls were there, half yearly results were there, yearly results were there. So I gave 5 and 5 score. Moving forward to section two, business concentration risk is not there. So I gave 5 and 5 score. Revenue growth versus receivables, if you see, it has been good, but on an average, the receivables by revenue comes out to be a bit higher, but this year it has been fine. So I gave 3 on 5 score. Operating cash flow by EBITDA. If you see FY24, the reason which they are saying the it was negative was they had raised huge funds. I think the results come out in March, but from January to March, in 3 months they had raised more than 100 crores. Due to which I think this had happened. So I gave 3 on 5 score. And inventory also, because of this liquidity from the funds, they had piled up inventories. So due to which the inventory number also went high. So for that reason also I gave 3 on 5 score. But cash conversion cycle, if you see, the reason why I gave 3 on 5 is that cash conversion cycle for other businesses in the same industry, wires. I checked with GK wires, I checked with dynamic cables. DSO and cash conversion cycle are all approximately in the similar range. So due to that reason, I gave 3 on 5 score. Moving forward, capex versus revenue, so it was good. So I gave 5 and 5 score. Debt, as I said multiple times previously, they have completely gotten rid of that debt. They are debt free now. So I gave 5 and 5 score. Liquidity position has been good, so I gave 5 and 5 score. ROE and ROCE has been a bit variable, but if you say in FY25, it has come down a bit. So I gave 3 on 5 score. Revenue growth has been fine, but margins, as I said, margins is a problem because the management is not much focused on it. So I gave 3 on 5 score for that reason. And after this, the overall score from our framework comes out to be 70.
Before we deep dive, quick note, we are opening Early Edge Club to a small founding cohort of 15 to 20 serious microcap investors. We are building a research first community where we break down businesses together. Every month, we deep dive into two microcap stock chosen by the community. You will be surrounded by thoughtful, like-minded investors from diverse backgrounds, and we are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Up to the management for scripting this turnaround. Really great story. 2008, 7, 8, 9,
Yeah.
then went into huge distress and a very good turnaround in the last 5 years. It's up to them. Debt has been very low, partly due to the factor like there's huge industry tailwinds. And as you were saying, I was also looking at the comparables. Why is one of the question is why is Paramount Communication trading at a PE of 21 when other comparable companies are trading, like for example, Universal Cable or a Dynamic Cable, are trading at a PE of around 30. Phenolix Cable is at 21, but haven't analyzed that. So before going there, let's just quickly do a smart analyzer. Okay, smart analyze and see the current valuation. So they have been growing extremely aggressively. As you mentioned, the management is not very conservative or when it comes to margin. They're more focused on growing their top line, willing to compromise on the margin. As you can see, like FY25, they did 6%. Before that, it is 9%. So it becomes a bit difficult for us to project the future EPS and the net profit margin, etc. So that is one thing, but a huge industry tailwinds. As long as that is there, they should do good. And based on the best case scenario, let's be conservative and do 1.7. If they are growing at around 30%, 25%, they should be able to do 1,800 next year. Based on that, the price target comes to 44. And if you're giving a PE of 20, then it increases to 50. The current price is at 60. So on this, it looks to be fully priced in on a 1 year forward basis. But if we are a longer time frame, so in this case, again, since it's difficult to estimate the operating cash flow, it's very fluctuating. Let us take the net profit of 87 for the previous financial year, and they are raising a lot of capital. This time they're raising a lot of capital through equity. I think the previous time it was through debt in the 2008 cycle. This year, I think they learned the lesson of not going being highly levered, and they are raising. But then that's bad for an equity investor because it leads to constant dilution for us. And if the trailing is 15, the implied growth rate the company has to grow is 26%. which the management projects to grow at 30%, so a 25% CAGR based on these parameters looks extremely doable. So if you have a longer time frame with lesser equity dilution from the company, I believe that a 25% CAGR should be possible. Now, coming to why it is trading at a lower multiple is one because of the uncertainty and aggressive capex. We have studied dynamic cable. They are much more, yeah, they're much more conservative. They are very clear that they want to keep their margin profile between 9 and 10. And if you see the last 5 years, it has been in that range. That is not the case. So there's a higher cash flow conversion that is happening in case of dynamic cable, and that's why you see like it is pretty much consistent. And one thing that is consistent across the board is every company is doing huge capex. Even Universal in cable, you see they're doing huge capex of 163 crores. There's huge capex that is being Paramount. Again, there's huge capex, 50 crores, 60 crores. So across the board, all the companies have started doing huge capex. Hopefully, it does not lead to overcapacity. If you these are smaller companies. If you take big Polycap, KEI, the capex is much higher. So there is demand. Secondly, why it is again trading at a lower multiple should be because of the cash conversion, though it has down of late, it has been quite high, around 100 days plus. You take dynamic cables cash cycle, it's pretty same, but it's below 100. So this could be one of the reason. And second, the ROC profile is like 25. The ROC profile for Paramount is quite lesser. It's below 20. So this could be the another reason. But the growth is much higher in Paramount comparable. Dynamic cable management is pretty much more conservative. So the risk reward in a risk reward perspective, Paramount looks much more attractive compared to a dynamic cable. But dynamic, I think you have the stability when it comes to the margin profile and cash flows. Any closing comments?
Like that, as you said, because they were one of the top companies before 2008 crisis, they are trying to recover it. They want to become the largest wire and cable
Yeah,
manufacturer in India
yeah,
today. So with that aim in mind, they have to just take care that not to
yeah.
overdo it, not to be so aggressive that again that same thing happens without any
Exactly.
crisis.
Build too much
So
capacity,
that
then
is
the
one
capacity
thing.
utilization is low, and they're not able to,
Hmm.
the expenses balloon, and then you go into losses. Not necessarily that lead
Yeah.
to losses, but then wrong investment or capital allocation decision can also lead, capital misallocation can also be a problem. But at least they're doing in a sector which is a good tailwind, so that is the positive. I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20 factor scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching, and we will see you in the next one. Bye bye.